Breaking news, investors. The yield on the 2-year Treasury has officially dipped below that of the 10-year. Is this the financial equivalent of a yellow light? Buckle up as we decode what this yield curve twist means to your investments and the economy. Today we're tackling a topic that's got Wall Street buzzing. What typically happens when the yield curve normalizes? Don't worry if this sounds like financial gibberish. We'll break it down together. First things first. Let's talk about the yield curve. Imagine it as a graph showing interest rates for U.S. Treasury bonds of different maturities. Usually it slopes upward, with long-term bonds paying higher interest rates to compensate for the increased uncertainty of a longer time horizon. In other words, you could pay a higher interest rate to compensate you for the fact that there's a lot more that can go wrong in 30 years than in 2. But sometimes it gets a little topsy-turvy. Now, you might be wondering, why should I care about some wonky graph? Well, here's why. This curve has a reputation as a crystal ball for recessions. Let's dive into the fascinating paper that explains why. Dr. Campbell R. Harvey of Duke University wrote a paper called Yield Curve Inversions and Future Economic Growth. I'll put a link to the paper in the description. So this sounds thrilling, right? But actually, this is where it gets good. Dr. Harvey found that when short-term rates are higher than long-term rates, what we call an inverted yield curve, simply put, it often predicts a recession. It's like the bond market's version of a magic 8-ball, but with much better track record. If you'd like to learn more about Dr. Harvey's thoughts, I'll put a link to a video interview of him that was done by Moody's chief economist, Mark Zandi, at the end of the video. I highly encourage you to check it out. After you've finished watching this video, to the end, of course, I think you'll find his updated thinking quite fascinating. So this predictive power isn't just a fluke. This yield curve has correctly signaled almost every recession since 1960. That's a better record than most weathermen. But here's the kicker. When the curve starts to normalize again, much like we're seeing now, it doesn't mean we're in the clear. It often signals that we're nearing the downturn. But remember, it's not perfect. Like that one time when you trusted your GPS and ended up in the middle of nowhere, the yield curve can sometimes lead us astray. For example, it gave us a false alarm in 1966. Speaking of the past, remember the dot-com bubble of the early 2000s? Investors were riding high on tech stocks, but the yield curve started to invert in 2000. A few savvy investors noticed this and began shifting their money into safer assets, government bonds, high-quality corporate and municipal bonds, and even cash. And when the market finally crashed in 2001, those who had prepared didn't just survive, they thrived. Now, you might be thinking, that's great for the history books, but what about now? Great question. And I like the way you think. There are a few reasons why this time could be different. 1. Central bank intervention. The Fed's been more active than a caffeinated squirrel, which could muddy the waters. They've been focused on achieving what they refer to as a soft landing. That means they've raised interest rates to try to stop incredibly high inflation. That causes the economy to slow down a bit. But just like driving a car, you don't slam on the brakes every time you need to stop. You slowly and gently bring the car to a halt. And that's what the Federal Reserve is hoping to do now. Stop inflation, but not stop the economy, aka a recession. Second, global interconnectedness. Our economy is more linked to the rest of the world than ever before. We can file this one under there's a lot out of our, the United States, control. Because the global economy is so interconnected, there are tons of outside forces that could push the economy into recession or right back into super high inflation. Third, unprecedented event. Let's face it, the last few years have been unique. Russia invading Ukraine, Ukraine invading Russia, Iran and Israel exchanging blows in the Middle East, and I think I heard something about an election. This list just seems to go on and on, day after day. All of these events impact our economy. Just one of them could be the one that tips our economy one way or the other. But don't let that stop you from preparing. Here are some ways investors often brace for possible recession. 1. Diversify your portfolio. Put all of your eggs in one basket. The logic here is that some things may fall while others rise, minimizing any damage a recession may cause. 2. Build up cash reserves. Having a cushion can help you weather the storm. 3. Focus on quality. In tough times, the cream rises to the top. Recessions are difficult for corporate and municipal bond issuers, so pick high-quality ones that have the best chance of surviving, even succeeding, in a recession. 4. Most importantly, don't panic. Markets go up and down. Too often, small investors panic sell when markets are down. Buy more things like individual bonds, where you know exactly what you're going to get and when you're going to get it. Interest and principal payments on bonds don't change because the economy is in recession. Individual bonds can be a stabilizing force in your investment mix. If you're finding this helpful, don't be shy. Hit that like button and subscribe. After all, it's free for you, and it helps the channel a whole lot. Now here's a little bonus for sticking with me. When the yield curve starts to normalize, it can create a sweet spot for certain bonds. Keep an eye out for high-quality corporate and municipal bonds with maturities in the 5 to 7 year range. As the curve normalizes, these offer a nice balance of yield and stability. But remember, high quality. Don't go reaching for yield in junk bonds, as they can be the most vulnerable to default during recessions. Here's another insider tip for you. Compare the taxable equivalent yields on municipals versus taxable returns on corporates and decide which is the most beneficial for your individual situation. I was in an investment club and we simply purchased a 5-year treasury note ahead of a recession. We collected some interest payments for a while, and then when interest rates declined sharply, we sold at a very nice profit. Speaking of staying calm, here's something I actually use in my own bond investing. When the yield curve starts to normalize, I don't panic. I keep a cool head, avoid emotional decisions, and focus on the credit quality of my bonds. I keep collecting those interest and principal payments, rain or shine. Those reliable interest and principal payments can also generate the cash needed to take advantage of stock and bond market dips that are often associated with recessions. Now, let's consider what bond investors can do when the yield curve normalizes. Here are some strategies to consider. 1. Ladder your bonds. In other words, spread out your maturities to balance risk and return. 2. Consider some shorter bonds, like treasury bills. They can often make cash available for stock market buying opportunities, or my favorite, rising interest rates, which means I can buy some high-quality, higher-yielding bonds when I've got some available cash from maturing T-bills. 3. Keep some powder dry. Keeping some cash ready lets you pounce on some of those same opportunities. Remember, normalizing doesn't mean normal. The bond market can be as unpredictable as a cat on catnip. Stay informed, stay flexible, and always do your homework. Here's one last pro tip from the trenches. When the yield curve is normalizing, pay attention to the speed of change. A gradual normalization often allows for a smoother transition in the markets. If it's happening rapidly, it might be a signal of more volatility ahead. In that case, consider shortening the duration of your bond portfolio to reduce interest rate risk. Lately, we've been seeing a lot of volatility in the bond market, but an overall gradual trend of declining interest rates. Today, picking up some shorter bonds might get you two things: a defensive play and a decent return while you're riding out a possible recession storm. As for bond investors, this could also be a good time to lock in longer-term bonds if you think rates are headed lower. Why? Because when rates drop, those longer-term bonds see their prices rise, but just as important, your opportunities for bond yield may not be available in lower interest rate environment. But always keep an eye on that credit quality. If a recession hits, you want bonds that are going to pay you back, especially when there's economic turbulence. If you're hungry for more bond knowledge, why not check out our videos on bond basics in the playlist appearing on your screen now? And please subscribe to the channel. Thank you so much for watching. And remember, while we're here to educate and entertain, this isn't personalized financial advice. Always consult with a financial professional before making investment decisions. Check out the full disclaimer in the description below. Thanks again for watching.